I'm Daniel.
And I'm Mira.
So imagine waking up today, you check your phone, and it looks like World War III is basically starting.
Yeah.
I mean, the Strait of Hormuz is completely blockaded, oil is just skyrocketing. But then, you finish your lunch, and the market is staging this jubilant, massive rally. Welcome to the deep dive. Today, we are unpacking, honestly, the most severe case of market whiplash we've seen all year.
It was a truly historic day on the tape. Today, we're going to look at the mechanics behind this price action ride, exploring why the market totally panicked at breakfast, why it completely reversed direction by the afternoon, and what underlying structural forces are actually driving these massive swings.
Exactly. And just as a quick reminder before we really jump in, today's deep dive is strictly for market context and discussion. It's not personal investment advice or a recommendation to buy or sell anything.
Right. We are just here to help you understand the narrative baseline that the market is operating against.
So here is our roadmap for today, which is Thursday, June 11th, 2026. First, we're going to unpack the deeply dark macroeconomic setup that hit the wires right before the opening bell.
Yeah, and from there, we'll walk through the dramatic intraday reversal that absolutely crushed market volatility.
Totally crushed it. After that, we're going to look at the unstoppable corporate tech bid that somehow just completely ignored the geopolitical chaos today. And finally, we will wrap up with our live paper trading segment.
The broader narrative today, it really hinges on understanding the sheer scale of the morning panic.
So let's start right there. Session 1. Just how dark did the macro picture get before the U.S. session opened?
Well, to really understand the fear at the opening bell, you have to look at the carryover from the prior session on Wednesday, June 10th.
Right.
We already had tensions erupting into direct military strikes between U.S. and Iranian forces. But overnight and into the early morning hours of today, June 11th, that escalation went to an entirely new extreme.
It really did.
The rhetoric from both sides went absolutely maximalist. We saw Iran's Joint Military Command officially declare the Strait of Hormuz completely closed to all commercial and oil traffic.
Which is, arguably the single most critical choke point for global energy transit.
Yeah, absolutely.
And in response to that blockade, former President Trump countered by explicitly threatening to seize Karg Island.
Yeah, and for listeners who might not track Middle Eastern energy infrastructure day to day, Karg Island is the absolute nerve center of Iran's oil export capabilities. Like, if you take that island offline, you essentially unplug the country from the global energy market entirely.
Wow.
So the market reaction to these twin threats was just violent. WTI crude oil spiked to an overnight high of $93.64 a barrel.
And when energy prices spike that aggressively, it instantly starts bleeding into the broader macro data. We saw this hitting our desks all morning.
Yeah, the headlines were brutal.
For instance, the World Bank came out and slashed its 2026 global growth forecast down to just 2.5%. And in their report, they specifically cited this expanding war and a projected 22% spike in average commodity prices.
Right, and even OPEC had to step in. At 8 a.m. Eastern Time, they downgraded their 2026 global oil demand growth estimates, cutting it down to 970,000 barrels per day. What you're seeing in these reports is the market staring directly over the cliff of 1970s-style stagflation.
Okay, let's unpack that mechanism for a second, because the word stagflation gets thrown around a lot. We're talking about a scenario where economic growth is stagnating, which explains the World Bank and OPEC downgrades.
Right.
But inflation continues to aggressively run hot, and that puts central banks in an incredibly dangerous trap.
It's the absolute nightmare scenario for any central banker. Normally, if economic growth slows down, a central bank will just cut interest rates.
Yeah.
By making borrowing cheaper, you encourage companies to expand and consumers to spend, which, stimulates the economy.
Right, that's the standard playbook.
Exactly. But when you have a massive external energy shock, like this Strait of Hormuz getting shut down, inflation starts ripping higher regardless of underlying consumer demand.
Because the physical cost of energy is baked into the price of literally everything.
Yeah.
If a product is grown, manufactured, or shipped, it requires fuel.
Precisely. So the central bank is trapped. If they cut rates to help the slowing economy, they add fuel to the inflation fire. But if they hike rates to fight the inflation, they risk choking off whatever meager growth is left.
And we saw that exact dilemma play out in real time this morning. At 8:15 a.m. Eastern Time, the European Central Bank decided to hike its key interest rate by 25 basis points.
Yeah, bringing their deposit rate to 2.25%.
Right. And during her press conference, ECB President Lagarde explicitly pointed to the Middle East war. She stated that the conflict is generating such severe inflation pressures that this rate hike was mathematically necessary across all their projected scenarios, precisely because of the energy shock.
And we saw that identical inflation dynamic confirmed here in the U.S. just 15 minutes later. At 8:30 a.m. Eastern Time, the U.S. Producer Price Index, which measures wholesale inflation, printed a hotter-than-expected 6.5% year-over-year headline number.
It is worth noting, though, that the core PPI, which strips out the volatile food and energy components, was actually softer at 4.9%.
True.
But when oil is threatening to break $100 a barrel, headline inflation is what dictates market sentiment. It acts as a massive pipeline.
Yeah, totally.
Like when wholesale energy costs are up at 6.5%, businesses eventually have to pass those costs on to the consumer, which means core inflation will inevitably catch up.
Exactly. So the market was bracing for this protracted, deeply inflationary conflict.
But I want to challenge that assumption for a moment, because the instinct is to view a military escalation like this as an unpredictable natural disaster, right? Something that just happens to the market. But looking at it through a game theoretic lens, I have to ask, were these maximalist threats, a total blockade of Hormuz, threats to seize Karg Island, were they actually just calculated posturing?
Like a negotiation tactic.
Yeah, using geopolitical brinkmanship as bargaining leverage to force the other side to the negotiating table. We aren't taking any political sides here, but from a pure mechanics standpoint, it feels like an escalation designed specifically to trigger a rapid de-escalation.
Well, it's a valid theory. In high-stakes negotiations, sometimes you have to walk right up to the edge of the cliff to prove you're willing to jump. That forces the counterparty to finally make a deal. But regardless of the underlying strategy, the market woke up pricing in the cliff. It was a heavily risk-off environment dominated by war and inflation fears.
Which makes the pivot even more incredible. So, to wrap up session one, we had this heavy risk-off morning setup where inflation and war were entirely dominating the narrative. We're going to take a short break and then jump right into how it all flipped.
See you in a minute.
And we're back. So session two, how did we go from maximum panic to a massive risk-on relief rally during U.S. trading hours?
The narrative completely flipped on a single social media post. At 1:28 p.m. Eastern Time, former President Trump posted on Truth Social that scheduled strikes against Iran were canceled. The tone of the entire day shifted instantly.
It was a sudden and aggressive de-escalation. By 3:30 p.m. Eastern Time, he was giving remarks from the Oval Office outlining a Qatar-mediated framework agreement.
Right.
According to the reports, the framework includes Iran committing to dismantle its enrichment infrastructure and limit missile production. And in exchange, the U.S. would lift its blockade and physically reopen the Strait of Hormuz.
The market reversal was just historic. Today's price action acted like a massive pressure valve. All morning, the geopolitical steam was building the blockades, the oil spikes, the rate hikes, compressing the market. But the second that peace framework was announced, the valve released and all the compressed capital exploded upward into equities.
Let's look at the numbers because it was violent. The S&P 500 had scraped a session low of 7,268.94 in the morning. But as this peace news hit the wires, it just ripped higher, surging to close at 7,394.30.
The fear just evaporated.
Yeah.
The VIX, Wall Street's primary fear gauge, collapsed from an intraday high of 22.32 all the way down to 19.45, and that catastrophic energy premium was completely wiped off the board.
Wiped out.
WTI crude plunged from those overnight $93 highs, dropping a massive $7 to settle at $86.50. The 10-year Treasury yield also dropped, closing at 4.463%.
But I'm struggling to understand something here. Is the market being incredibly naive?
Why do you say that?
Because while the U.S. equities tape was celebrating this framework, Iranian officials were publicly stating that no final decision had been made. They emphasized that their supreme leader still has to give final approval.
This is a perfect example of markets pricing ahead of physical reality. The ink is not dry on any agreement. The commercial ships are not freely passing through the Strait of Hormuz yet. But the equity market is pricing the deal as if it has already been fully executed and signed into law.
Right.
They are buying the rumor of peace.
And if you look past the euphoric stock market, the bond market was quietly sending a very different, very serious warning signal.
They certainly were.
Yeah.
At 1 p.m. Eastern Time, right before the peace headlines really took over the narrative, the U.S. Treasury held a $22 billion 30-year bond auction. And that option cleared at an elevated yield of 5.02%.
Okay, let's break down why that matters. Why should a stock investor care about a 30-year government bond auction on a day when peace is supposedly breaking out?
Because a 30-year Treasury bond represents the baseline risk-free rate of return for the entire global financial system. When an investor can lend money to the U.S. government for 30 years and get a guaranteed 5.02% annual return, the math changes for everything else.
Yeah, that's a high bar.
Exactly. Why would an investor take on the massive risk of buying a highly volatile stock unless they expect a return significantly higher than that guaranteed 5%?
Which brings us back to the concept of discount rates as financial gravity.
Precisely. Every single corporate valuation model requires an analyst to discount a company's future expected cash flows back to the present day. And the primary number they use for that discounting is the Treasury yield. When that risk-free yield crosses 5%, the mathematical present value of a company's future earnings gets crushed.
Yeah.
That financial gravity hasn't gone anywhere. Even with hopes of peace and cheaper oil, long-term borrowing costs for the U.S. government are sitting above 5%. That heavy burden continues to weigh on the valuation of long-duration assets.
So to recap the intraday action for Session 2, we witnessed a historic reversal. The energy risk premium vanished on the back of a sudden peace framework, sending equities surging. But the physical reality of the blockade remains, and the heavy gravity of 5% long bonds is still unresolved.
Exactly.
All right, let's take one more short break, and then we will dive into Session 3.
That's good.
And we are back for Session 3. Beyond the macro whiplash, what drove the massive corporate tech bid today? Because one sector seemed totally immune to the chaos.
It was wild. While the rest of the market was swinging violently on every geopolitical headline, the mega-cap tech sector just put its head down and kept marching. XLK, the tech sector ETF, surged 3.1% today to close at 183.21.
I have to ask, why did tech surge 3% when the threat of war means shipping costs are spiking and servers cost more to run?
Because the AI CapEx supercycle marches on, completely untethered from the broader economy. We were talking about a $700 billion structural driver that completely ignored the morning panic.
Let's look at the software and pricing side of this arms race first. Overnight, going into today, Thursday, June 11th Eastern Time, OpenAI announced a major partnership to use Oracle's cloud infrastructure. But at the exact same time, reports leak that OpenAI is considering steep token price cuts.
This is a crucial development. By slashing the cost of tokens, OpenAI is essentially executing an attrition strategy against their main rival, Anthropic.
Right, it's a pricing war disguised as an AI war.
Yeah.
They are forcing Anthropic to burn through their venture capital just to maintain their market share. When you have billions of dollars in backing, you can afford to operate at a massive loss on the compute side just to capture the entire developer ecosystem. Once developers build their applications entirely around your specific API, they're locked in.
And the private funding markets are more than happy to finance this war. Prometheus, an AI startup backed by Jeff Bezos, just raised an astonishing $12 billion. They're now sitting at a $41 billion valuation. Bezos himself came out today predicting severe labor scarcity because of rapid AI adoption.
But all of this software ambition eventually hits a physical wall. There is a massive hardware and infrastructure bottleneck forming. Google is reportedly having to turn to Samsung for its future AI chips because global manufacturing capacity is just that incredibly tight.
Right.
Meanwhile, Anthropic is out there securing financial backing directly from Google just so it can pursue its very first direct data center leases.
This completely validates the theme of power access as an AI scaling bottleneck. The industry has realized that it's no longer just about writing better code or having smarter engineers.
Yeah.
It's a brutal physical land grab.
Yeah.
It's about securing the real estate, the electrical grid access, and the actual silicon required to run these massive models. If you don't have the power access, your software doesn't matter.
And from a broader market perspective, this mega capex as a market fragility mask continues to be the dominant story.
For sure.
The sheer volume of money being spent by these 5 or 6 tech giants is carrying the overall profitability of the broader S&P 500 index. It's masking the severe weakness in lower margin, economically sensitive businesses that are currently choking on those 5% interest rates we just talked about.
It truly is a bifurcated market. The tech giants are playing a completely different game than the rest of the economy.
Well, folks, that's the closing bell on a day where we proved you can wake up to World War III and still close green by lunchtime.
Yeah.
Only in this market can the Strait of Hormuz get blockaded, the ECB hike rates, and tech still rally because someone said AI again. If you panic sold your portfolio at the open, don't worry, I hear OpenAI is cutting their token fees so you can afford to ask ChatGPT how to make your money back.
Oh, wow.
For the rest of you diamond hands who bought the dip, congratulations. Just maybe don't buy a yacht that needs to transit the Gulf of Oman anytime soon.
Good advice. So looking past today's volatility, what should we be watching next? Tomorrow, Friday, at 10 a.m. Eastern Time, we get the University of Michigan Consumer Sentiment and Inflation Expectations Report. Given the recent spike in oil, those inflation expectations will be heavily scrutinized.
We also have Adobe fiscal Q2 earnings and guidance coming out Thursday after the close, which will serve as a major pulse check for broader enterprise tech sentiment.
But without a doubt, the real overnight risk is waiting for crucial follow-up headlines on the U.S.-Iran peace process. The equity market has already priced in the good news. Now we need to see the physical reopening of the Strait of Hormuz to justify those valuations.